Hey guys, so there's a lot of content on the Black-Scholes equation, specifically pricing things with the Black-Scholes. It's a really simple, just closed form formula, and most of the time they just kind of hand wave through some ideas, and then typically just give you the formula, and then calculate it from some log normal distribution, and you're done. There's your call option, there's your put option formula, some boundary conditions, boom, you're done. Now, that's not really what the Black-Scholes is, and it's very misleading, because fundamentally the Black-Scholes equation is about replication, portfolio replication, and even you don't even want to use these. It's not a mathematical thing. Black-Scholes is not some mathematical. It's not doing anything interesting mathematically. Even if you were to construct some risk neutral measure, rate on negative derivatives from physical price space to risk neutral martingale price space, like those types of things are all extraneous mathematical machinery that even then it's nothing novel, right? There's nothing particularly interesting about the Black-Scholes equation. What's more important to understand is the notion of self-financing and delta hedging of a portfolio that enforces no arbitrage. Now, so you have to think about the Black-Scholes as well as not about predicting or speculating stock prices. That's not what it's about. Black-Scholes is about constructing a portfolio, continuously maintaining that portfolio, and reproducing an option payoff that then determines some unique price that makes this possible. So you should already kind of understand that options are priced by manufacturing them, not forecasting them under some measure, right? Some expected value. Like they'll always say, yeah, you have some kind of expectations about how the payoff is going to be. That's how you price it. That's not what the Black-Scholes model is about. Okay, that's more like Feynman-Kac theorem type of forward, or sorry, I think it would be forward heat equation or Kolmogorov forward equations. Anyways, what we're going to do is derive something. We're going to generalize Black-Scholes to be more financially, to carry more financial meaning by abstracting it into Lie theory and Lie algebra. And that's basically what we'll have the Black-Scholes generator from replication to show why a particular stock's drift is irrelevant, because that's fundamentally what's most important in understanding the Black-Scholes model. And we're going to actually linearize it for fun to the heat equation, or if we were to Wick rotate the heat equation into a Schrodinger equation. And so, which linearizes and it linearizes the operator itself, and we can read the geometry of it. So it's pretty cool. It's fun, but we first need to ask a really important question. If you sell a call option, right? Why would that option have a unique fair value, or should that option have a unique fair value? And some important things to note is that when you sell an option, it creates a liability. So is there a way to eliminate that liability through some kind of trading strategy with some holding some bonds or some stocks or anything like that? So you only owned stock and cash. Let's just stay with that for a second. Is there a way to reproduce the option payoff? That's really what we're asking here through all of this, all of these ideas. So what you need to do is think about this as an engineering problem, right? Black-Scholes says, yes, you can do this, and you need to construct some kind of machine that's going to output exactly the same payoff. And the option price is going to equal the cost that it took to construct that particular portfolio, not the expected profit. And so you'll think about, again, you have to emphasize when you're financially reasoning with the Black-Scholes model, right? The Black-Scholes model is different from the solution to the Black-Scholes equations or whatever. The Black-Scholes model is fundamentally about replication, not speculation. And manufacturing payoff, dynamic trading, capital transport, cost of today. So you can think about this really as actually pricing is therefore a capital transport problem. Because a good analogy for this would be like if you have a bridge, right? You're trying to bridge from, you know, one point in time to another point in time for some, time now to maturity. Different contractors are going to estimate different future costs for that bridge. But the cheapest physically possible construction is going to actually determine the marketplace. That is the type of problem that is a type of financial reasoning that you have to use. And so what Black-Scholes is asserting is, again, that the price or the value of the option versus some hedge portfolio is possible to replicate this entirely. And this can be, this explains why options have a unique fair value to begin with. Okay? And so now what we can do is set up a kind of geometric framing of the problem. We can fix a state space or a configuration space with some coordinates, the underlying and the time, as well as some z coordinate. The z coordinate is this latent factor. You can think of this as like how stochastic vol jumps, funding stress. We can just say that it's trivial or it's just null. There's no extra things that we'll talk about with the latent factor right now, and that will be the Black-Scholes limit. That's what we are going to. It's going to be this kind of fixed point within the geometry, the space that we're constructing, and sigma is a constant. So that's also what is specified in the Black-Scholes model. Sigma is a constant. We have a latent factor that is 0. Okay, so there's no stochastic clustering. There's no volatility clustering, no funding stress or random jumps. Okay. Now, there's arbitrage-free call surfaces. What you want to think about is, and I'm assuming that you're familiar with the Black-Scholes model, just somewhat familiar with it. Now, admissible prices. This is basically a surface of admissible prices that satisfy the arbitrage-free constraint. So static no arbitrage, you have monotonicity and strike, convexity and calendar spread. This actually just defines a manifold of arbitrage-free of a price surface before any model is ever chosen. And what's nice is the Black-Scholes implied volatility becomes this coordinate chart, not as this fundamental state variable, but many volatility shapes can represent similar prices in the liquid core. So again, the markets possess themselves states of price and time, admissible prices, and constraints. So the option surface will live on a manifold. And so because we have coordinates and stock price, time, and some variables, the option surface is the object itself, not the volatility. And that's why it kind of avoids, or it just properly builds that the specific, when we study volatility surfaces, we have all of these different models that we calibrate these. Gathariel, his option surfaces book, just goes crazy into all of these Heston and other types of car Medan like methods of pricing options. So there's a whole continuum of ways to think about options, but it makes so much more sense that the actual arbitrage-free call surface itself is the fundamental object. That I just wanted to, and that's why it is geometric. That's why we're calling upon differential geometry. It's smooth manifold itself. Okay. That was kind of a lot, but no arbitrage just already tells us an enormous amount of information, because prices have to decrease with strike, right? They also have to remain convex and increase with maturity. That's all that we're saying. So this is what allows us to have the admissible transformations of this surface should preserve self-financing, no arbitrage, and scale homogeneity. So that's kind of everything that should be talked about. Okay. Now we're gonna seek basically some kind of pricing operator that is going to be built from the Lie generators that respect all three of these particular admissible transformations. And so the black-scholes model itself is going to be this constant coefficient operator whose null space is the set of replicable claim values under perfect delta hedging. Okay. Now, delta hedging, that leads us to the next notion, which is that we want to construct some kind of replicating portfolio that holds some phi shares and some units of the money market account, basically your cash account. Okay, so this is your replicating portfolio that's going to be done with cash and with a strategy. Now, self-financing means that there's no external flows when rebalancing. So if we were to change either phi or psi without injecting or withdrawing cash, every single change in portfolio value must come from how the market moves in the assets already held. So I want to explain this very carefully, because self-financing just means that no money will magically appear, right? Every rebalance that we do is going to be financed internally within this system. That's what we mean by self-financing. Now, this is basically an accounting identity, because if external money enters, right? If we have external money that we're putting into it, the portfolio replication argument is going to break, because we're not replicating the portfolio anymore, because that's just kind of how it is. Okay. So, for whatever differential changes in our stock, or however the drift that we get from our stock price and from our cash account itself, there's no conservation there. All right. Now, delta. How is delta going to enter? Now, a delta hedged book then will track the option minus the stock hedge. So what we're basically saying is how many shares reproduce one particular option. We're not asking how much risk there is. Delta is not associated with risk. I've seen a lot of YouTube videos that have done that, and they're incorrect. Okay? So, delta itself is just how many shares will reproduce one option. All right? Now, the hedge itself allows us to think about that at every single instant, the option becomes slightly more stock-like or less stock-like. And delta tells us just basically how many shares to hold. And so we have a little visual here that hopefully it demonstrates, the stock position itself, the cash position, the combined portfolio here that is being replicated, and then we have the option and the cash leg all together that give us exactly what we're looking at. So we can see that the replication process itself, that the black-scholes model is giving us, is a dynamic thing, and you're continuously having to repair the hedge itself, continuously. Okay. And so obviously there's going to be some kind of rebalancing or some periodicity of rebalancing that happens, but just keep that in mind. Okay. So now what we're going to try to do is, the stock itself is going to have some kind of random term, and this random term is usually associated with some kind of physical measure. Now we want to avoid measure theory. And for the reason of just for the sake of financial, for adequate financial reasoning, and the assumptions that we have made up here for the black-scholes model, we don't need to use much measure theory, because we can cancel out this random drift term that would, under any physical, we can basically make it drift independent. All right, we can cancel out the mu, this mu here. So under geometric Brownian motion, well, first of all, this is really, it's just, we're trying to explain why this hedge works. So remember, the the stock is moving randomly and the option is moving randomly, but the random parts themselves are going to try to line up this DW term. Okay, so we're going to choose some. We essentially need to choose some delta correctly, right? And if we choose the delta correctly, the randomness is going to disappear after invoking Ito's lemma. And this Ito's lemma is basically the stochastic Lie derivative along the diffusion. If you have that differential geometry background, that's all this really is. And what's nice about this is why this is a very deep financial fact, or a mathematical fact, not necessarily financial, but it's this mathematical fact that allows Black-Scholes to be remarkable because it's not because Ito's lemma exists, right? The math itself isn't like, great, but it's because the market itself contains a traded asset that is exactly the same random shock. And so because we have the exact random shock, the drift itself also is going to disappear. So not only do we get to cancel out the DW terms, we get to cancel out the drift because the hedge neutralizes that particular exposure. And so once you're exposed to a zero shock risk, the investors are not going to care whether the expected return. Their investors are not going to have any expected returns because we've completely eliminated the hedge is neutralizing the exposure that we had to the Brownian shock. And we also have a convexity correction, which gamma itself is the hedging acceleration. You can think about this as a hedging acceleration because delta itself can change because it's a dynamic process. So therefore the hedge itself requires hedging. So you then have to rebalance, the delta, rebalance via the cost profit captured by the convexity or gamma. So that's kind of how this works. And if we had some, particular drift from mu, how it affects the option price itself, mu is affecting the drift, but it does not affect the replicated or the hedged portfolio. Okay. Now, next we can talk about the construction of the Black-Scholes generator. It's very simple. So after hedging, there's basically no remaining market risk. You've hedged away all the risk. Therefore, the portfolio is going to behave exactly like cash. And so a riskless portfolio, if it earned 10%, while treasury bills earned 5%, what would happen if I were to just look at this? Basically, everybody would buy it because there's infinite arbitrage, right? So that's something that's impossible because it doesn't explain why everybody's buying it, right? Nobody's buying it because the arbitrage doesn't exist. The market's already settled upon, or in a complete market, it's probably already settled such things. So that's kind of the assumptions that we make about arbitrage itself. Now, therefore, basically, if it's riskless, it must earn the risk-free rate. So that creates the Black-Scholes partial differential equation. The Black-Scholes partial differential equation comes from this particular arbitrage-free thing. Okay, and then from the two expressions for the differential of our portfolio replication, from no arbitrage and then the other things, we get an annihilation condition for a Black-Scholes generator. Okay, and you can read this as basically Black-Scholes in the PDE form is a balance sheet identity financially, because it's not a statistical law like you would have in physics. It's more of a financial type of law, if you will, or tendency invariant. It describes some sets of invariants because you'll have some theta time decay and then gamma the convexity, delta as a carry on the stock minus the funding on the mark sums to 0. There's no room for risk premium on the hedge book here. So essentially that's everything. And then of course this would be the infinitesimal generator of the pricing semi-group, and that can allow you to actually solve particular problems with under Black-Scholes assumptions. Okay? And we can view the no arbitrage here as some hedge portfolio, its value versus the spot, and the option itself. Okay? So, and we have that the replicated portfolio with under no arbitrage happens if and only if it's the annihilating operator acts on the portfolio, on the option, sorry. Okay? And of course for some maturity time. All right, so it's not arbitrageable at all. Now, also, yeah, so here would be the annihilation operator happening. There's a little bit of a clip here, but this is another way to view the Black-Scholes generator itself. So, yeah. Conservation of arbitrage-free replication. It's not a bet on the drift. That's right. That's also important. We're not betting on the drift itself. There's no directional bets. You're either the hedge is not riskless or the price embeds an arbitrage. There we go. Okay. So let's go deeper into why we want to destroy some of the, I guess, misconceptions about mu itself, why it doesn't appear in the price at all in any Black-Scholes type of model. Expected return matters. Most people think that's true, but that statement is not true. The expected return of the stock does not matter under option pricing because the hedging removes the first order exposure to the underlying. Now you can imagine some investor A, right? He expects, I don't know, 30%. Investor B expects negative 10%. Would the option prices differ? No, because they both hedge, right? They're both, that's just fundamentally what's happening. So the core lesson here is that pricing is not equal to forecasting. There's just, when you price something, that is completely different than forecasting something. Now, and you should probably separate those things in your brain financially. So a fair value is you construct a self-financing strategy, make it locally riskless, and then apply no arbitrage. And this is an arbitrage pricing that's not expected utility pricing. So you never need to estimate mu because the replicating portfolio carries net delta risk over an instant. It's instantaneous. The only remaining input besides the payoff is the volatility, which governs how fast it needs to be adjusted. So more volatile, the faster that delta needs to be adjusted. And that's called the gamma cost of hedging. All right? So we kind of show, again, computationally, that it doesn't matter if we get we have a unique option price place. It doesn't matter on the physical drift, okay, or the expected returns. But really, mu, why do we call it mu? The reason we call it mu is because that's the center of mass. The expected value of some distribution is just the center of mass of that distribution. Okay, or the center of mass coordinate. Okay, that's enough. Physicists will get this joke. Well, it's kind of a joke, but not really, because you have the moments. The moment is the volatility. But anyways, excuse the noise in the background. But finally, what we're going to do is talk about how there's geometry that's hidden inside of pricing itself when we think about pricing this way. So every partial differential equation, and why do we have a partial differential equation? Because of no arbitrage. So it has a symmetry, right? Black-Scholes is no different. we have time translation symmetry, and you can interpret this. If you have time translation symmetry, that refers to energy conservation in physics. But in finance, we think about this as decay towards expiry. Homogeneity in spots for the scale generator, and then the discounting generator. You can think about this as money market accrual. So you have time, and then the contracts that remaining, they give you a remaining opportunity. Scaling, this basically everything doubles in value, right? Or doubling everything in value with scaling, and then cash will just grow itself as exponentially, right? That's how we think about these particular generators. So the symmetries here are going to explain why the PDE has exactly these terms, and it's not arbitrary. So if we talk about lead generators or overwhelming, all of these things, just treat the lead generators as directions in which the financial system can actually move. Okay? And so we can maybe even think about deformations that are generated by further things like level, skew, curvature, term, spot, to perturb some kind of metric on this space of admissible call options or put options or whatever. And again, like I said, Black-Scholes is the fixed point of some kind of, it's a flat geometry, it has constant coefficients and perfect portfolio replication. So that would be kind of cool, right? So let's think about also the Greeks as replication geometry. So the derivatives are essentially these nice quantities that give us, they're basically business quantities. I mean, that's really what delta, gamma, and theta are. You can think of delta as the shares required, and gamma itself as the trading intensity, how much you need to trade when S moves. And theta is just kind of the cost of waiting. And you can think of this as like a hedge bundle or something. Okay? Now, if we wanted to formulate this into a differential geometric process, which I think would be very high leverage, but you can think about gamma and theta, how they fight with each other near expiration. So if we have huge gamma, right, and we have large hedge adjustments, that means that we'll have rapid theta decay. So a good intuition to walk away from the Greeks with is gamma is curvature and theta is the erosion of the value as time goes on of a particular contract or of a contingent claim. All right? And so there you go. You have delta killing the first order spot risk, but gamma itself is the cost of rebalancing when the underlying spot moves. Okay? Now, what we can do is reveal simplicity within this by linearizing, which is essentially what the Schrodinger equation is all about. We can take an original partial differential equation that looks very complicated, right? And what we can do is think about it as heat flow, with it written in financial coordinates. So if we were to just kind of change the coordinate systems that we use, let's say log moneyness with the strike, or the spot over the strike price with the time to maturity coordinates, we can then also invoke Euler symmetry to become just a regular differential operator, a partial differential operator, to get a Fokker-Planck type of equation. And then if we do a Galilean boost with some particular transformations here, we'll get the first derivative term to vanish within the Fokker-Planck equation to give us a pure heat equation. And this is a linear parabolic equation in the real numbers. If you change tau to be, if you rotate this is a free Schrodinger equation for a particle on the line. So the fundamental solution is a Gaussian heat kernel. Now, if you convolve this particular Galilean transformed function with G here, then our propagator, or sorry, not our propagator, our Gaussian heat kernel, the diffeomorphisms will yield the Black-Scholes formula, and so you get a linear diffusion of the payoff modulo the explicit coordinate changes that you did over here. So that's kind of a nice, I mean, just walking through this slowly again. Discounting, right? Discount the option to remove the financing. Log transform to remove the particular scaling that finance demands. Galilean transformation to remove that Fokker-Planck drift. And you just get pure diffusion afterwards. So that just means that every coordinate transformation removes one financial feature of this, and only uncertainty is going to remain. So you can think about the heat kernel as well as just this payoff that spreads backwards through time. So if you have a sharp kink or sharp strike contract kink, it's going to smooth away. That's how you can think about the heat kernel itself. And of course, so we can have that this linearization is going to, you can do this numerically and show that the operator itself, by discounting, is going to remove the funding, and moneyness removes the scale, remove the drift. So everything kind of checks out here. All right. So yeah, we'll move on here. And then, of course, here's the payoff diffusion under. So we have a kink at K that smooths as we go backwards for tau over T. Okay, tau over T would be regular time. And so we have this kind of like smoothing as we take the ratio of time, or this particular ratio, to be like 25% of the way to all the way to 100% of the smoothing. And we have this convexity in gamma as this kind of fingerprint that is working on the particular payoff distribution as well. Okay. And of course, you can think about tau as the time to maturity coordinate. And so, if we had some closed form, it eventually reaches around 7 here for the price of the option initially, as it's back propagated. It's backward priced. Okay. So yeah, and again, the payoff distribution would be what it would be if everything was paid off right now. Okay. So it's essentially everything so far. And yeah, so you watch the smooth backward under heat flow. Yeah. Okay, we've already talked about that. Now let's conceptualize everything, because this has been a lot. We think flat geometry itself gives us constant volatility and constant diffusion. If we want to think about a horizontal lift, the delta hedge itself is going to remove randomness. And backward transport is essentially the payoff and how the payoff flows backwards under the operator, the Black-Scholes operator. And then, of course, you can think about a little bit beyond Black-Scholes with real markets themselves, how they curve the geometry. One could introduce stochastic volatility, jumps, liquidity, and transaction costs as these geometric perturbations of the option pricing problem. And now we can think about, the nice point really is that Black-Scholes is the flat space approximation. And so that would be kind of the, the conclusion that we make from the beyond Black-Scholes thing is that, yeah, in flat space, we have Black-Scholes being locally satisfied. Okay? Now, you can just kind of think about how perfect hedging itself is going to require infinitesimally continuous trading. So we can play around with volatility here and see how hedging error might grow as we have more volatile. Let's say we have really less volatility. Um, the hedging error, let's just keep track of this here. We have 3.4. This is kind of taking the naked option P&L. And of course, so the P&L is kind of going down and down and down and down because of the volatility that's driving it below. But if we have strike price, and we choose different strike prices, it's going to change the profile of like how exactly we're going to rebalance, or how the replication is going to deteriorate. And so really the PDE itself, and then of course if we just keep having to rebalance and rebalance and rebalance and rebalance, it's going to drive the error pretty low. Especially actually I think there's a problem. Rebalance every 10 steps. It's rebalancing a lot actually. I'm only simulating one step, so it's okay. This is a discretization problem. Not the best example, but yeah, essentially, yeah, you can see the discretization is pretty bad. But this discretization is even like in the computer is why like I can't actually show you the perfectly hedged in practice option, because that's just kind of it's hard to get the infinitesimal rebalance interval, right? For so we're just seeing the replication itself deteriorate in my machine. But yeah, so that's basically everything that we have. The Black-Scholes model is replication, and it's the conservation of capital under no arbitrage and continuous hedging. So, you can think about just building some kind of portfolio, make it a self-financing portfolio, remove the randomness, apply some no arbitrage conditions, and obtain that partial differential equation. You could then be fancy and transform the partial differential equation to solve some kind of heat equation type system and then recover the option price. This is one of the cleanest ways to think about the Black-Scholes model itself. And this is worth really repeating several times. The financial lessons in Black-Scholes is that options really are these manufactured types of financial claims, and they're not predicted at all. They fundamentally the replication determines the price, not the investor opinion or any speculation. Self-financing is this accounting law that's underlying every derivation, and the delta is going to remove some kind of the delta itself removes this first order risk from the cost, but the gamma is going to measure the cost of maintaining that hedge. So that's why when you rebalance with gamma, it costs money to actually hold that hedge. And so the Black-Scholes PDE as well is also the balance sheet identity. It's not some kind of forecasting equation. Sorry, I'm going through some bullet points. No arbitrage replaces the subjective expectations with objective replication. The heat equation is simply the Black-Scholes expressed in the right coordinates. And real-world models like stochastic volatility jumps, liquidity, transaction costs, they're all geometric perturbations of the flat Black-Scholes geometry, not completely different theories. Okay, so that's kind of why. So you don't want to view this as just some sequence of algebraic manipulations, right? You always want to be thinking critically about what this financially means. What is the underlying assumptions of the model, and how is it used to construct financial products? Okay, thank you guys for watching, and I'll see you guys next time.